Well, De Beers on the diamond market have long held a fascination for South Africans. In its cover story this week, Finweek looks at the company and its expansion into India and Chinese markets. So to unpack all of this, we're joined by Tandisizwe Mahlutshana, Deputy Editor at Finweek, Andy Rice, Chairperson at Yellowwood, and Sasha Naryshkine, Director at Vestact. Welcome to you all. Thanks for joining us. So we know that De Beers has gone through a rough time during the financial crisis. Certainly was hard hit the diamond industry. Anglo-American has shown that they committed to their investment there, upping their stake in it. And of course we know that diamonds are certainly a girl's best friend. So tell us about the rationale behind taking the story further.
Well, I think there's an irony firstly that there's 4 guys and 1 woman on the table talking about diamonds today.
Yeah, it's not debatable, I mean, how much we love diamonds, but how much you're willing to pay is the next question.
Maybe we're the suckers that fuel the industry. Anyway, I think the story initially started out, David McKay was writing the story, was in London, and he got to sit down with the guys from De Beers and sort of talk about their strategy going forward. And I think there's a couple of different aspects to look at it. One is obviously the tie-up between De Beers, Anglo-American, and what this means strategically for them having diamonds as part of their portfolio. The second one is the De Beers strategy going into Asia and the ability to get into the Chinese market, the expansion of their Forevermark brand. And then ultimately, you know, there's always been this defensive attribute attached to luxury goods and luxury brand companies, and Richemont's a good example. And I think it's just a nicely put together story which looks at these different aspects from a company that South Africans know, and they know well. They remember that De Beers was once listed. It was once a it's kind of one of those really big exports that we've put out there, and we've become a leader in diamonds, but not in the listed environment now. It's a lot of these things and developments have happened behind the scenes. Yeah,
so delisted I think back in 2000. Sasha, let's start off with you. What are your views right now on De Beers, and I suppose from the investment perspective, we'll get into all of that with Anglo-American upping its stake in that. How does that make you feel about an Anglo-American strategy?
Yeah, interestingly, at the same time, remember that both Rio's and BHP Billiton BHP Billiton recently just sold their Ikati assets, so that's their diamonds gone. So obviously they're not forever if you're a BHP Billiton shareholder, and Rio Tinto have a strategy in which to get rid of them. So it was really contrasting to see Anglo-American make this big announcement. Maybe it was at an opportune time for them, and I guess longer dated they would have said to themselves, right, where are the big growth areas going to come from? And obviously with an adoption of Western type styles in China, because I can assure you the original Chinese marriage process doesn't involve diamonds, it involves tying of knots of pieces of silk. So there's been a massive change and a big adoption of Western cultures, particularly in the East where most of the population, world's population is. And that's going to be the strategy going forward, trying to replicate obviously what Tiffany have done in the US very successfully.
And it seems they're making, you know, strong headway in China. I think it's taken them 10 years to get 55% of the brides to have a diamond as a symbol of marriage. But Andy, from the marketing perspective, what are your views on the kind of value of the De Beers brand and what they've been able to do with kind of that symbol of marriage and unity and love?
Sam, I think De Beers is a great brand case study because they've done an awful lot of things right. They've been focused over time. They've taken a very long-term view. I mean, that line, "A diamond is forever," was written back in 1947, so it must be one of the longest-standing propositions in any market. They've understood the importance of a brand being able to talk both to the physical properties of the product and the emotional reward of the brand. So in the concept of eternity, they've cleverly found a single thought that addresses the geological history of diamonds and the enduring relationships and romance. So that concept of eternity works very well there. They've also understood how a market may evolve, and so what started off as a category brand, really describing diamonds per se, they've added to that a channel brand in the form of their tie-up with LVMH and De Beers Jewellery as a retail outlet. And now they're adding a product brand in Forevermark. So I think they've really seen the way that the market is changing and made sure that they have a proposition for each of those new areas.
Andy, one of the things is obviously the concept of blood diamonds has obviously really tarnished the diamond industry as a whole, both from the mining side of it, but also from the retail side of it. However, it seems to have disappeared at least at the most, it seems to be increasingly less visible from a retail consumer perspective. I mean, do you think that the investment in the Forevermark brand will ultimately pay off for De Beers from that perspective?
I think that has to be one of their concerns and one of the driving forces behind that decision, because I think it's 1% of all diamond production is deemed to be of sufficient quality to bear the Forevermark. So they're able to be enormously selective. And clearly, if there are in the category negative issues that can bring the category down, by leaving out 99% of the category, you can discard those as well.
Do you think that it gives the brand, you know, we always talk about the defensiveness of luxury goods, and particularly through the economic crisis that we see, and in principle, the majority of the brands have held up quite well. You look at the Cartiers, the Tiffany's, etc. Do you believe that luxury goods will continue to be a defensive sector right at that high end of the market?
I'm not sure they're defensive. I think they're very proud and they stand for something that without much disguise. And I think the fact that the luxury brands generally have suffered less through economic cycles than some more mainstream brands is indicative of that. I think that what they are trying to do is to introduce what they call the democratization of luxury, which is to make it more accessible without at the same time diluting its exclusiveness. And that's a tricky little road to follow.
Because it's almost a two-pronged approach that they have to have. On the one hand, you've got this Forevermark strategy, which is really to the upper end of the market. And then they've also got to appeal to the rest of the market who still want to get married and afford a diamond. So they have to have kind of that two-pronged marketing approach. I mean, do you think that they're getting that right?
I think as market leader, you can afford to take generic properties and promote them, because the simple arithmetic will mean that you'll get the lion's share of the benefit of that. So by promoting diamonds globally as a key component of the marriage ceremony, as Sasha was talking about, is very, very clever, because it's managing demand. It's stimulating demand, knowing that the leading brand in the supply side will get the bulk of the business, and that's De Beers.
I mean, Sasha, I guess one of the things that's obviously, I mean, you know the Richemont business quite well. I mean, it's been something that you guys have looked at quite regularly as a core investment holding. The reintroduction of 100% exposure to De Beers through Anglo-American, does it change the appeal of the business from that perspective, or would you prefer to rather look for the exposure through something like Richemont?
Yeah, in fact, if anything, worse. You know, why would the leaders, our lead resource investment is BHP Billiton, which obviously, you know, indicated a while back they wanted to divest from diamonds. Obviously, because if you have a look at the diamond industry, it's got a pretty patchy profitability record. You know, in fact, it was a massive recapitalization of the De Beers business, as the article discusses, not so long ago. Simply because, you know, it doesn't perhaps have as defensive a quality as, say, for instance, copper. We've seen a wild price ride pretty recently, but remember that copper is used in many durable goods, and obviously as electrification takes place, maybe it's a better commodity. So we've tended to ride the whole story of consumer demand globally for luxury goods through Richemont, and I guess we should be so lucky to be able to have that investment here in the local market, bearing in mind that there isn't another proper luxury goods retailer.
What about the strategy of getting into Asia, and irrespective of whether you are in the diamond industry as a De Beers, or whether you're on the front end of it as a consumer, maybe the Richemont consumer brand like a Richemont, is it paying off for those that were early movers there?
Absolutely, because what you've seen, Richemont's clear strategy was not to compete in the US, and obviously to get in the door early in China. Now, sales 5 years ago of Asia relative to Europe was a third. Now, Asian sales have overtaken European sales. And a lot of those European sales are actually Chinese tourists. So whereas, you know, you and I might go to Paris to see the Eiffel Tower or the Louvre or the Arc de Triomphe, you know, there are Chinese tourist buses that line up on the Champs-Élysées, and everyone gets out, and, you know, there's a queue that forms outside the luxury brand stores. You
kind of seem to be erring on the side of BHP Billiton here, is what I'm hearing.
Always.
If we're talking miners, you kind of like, I know you like the petroleum story, the iron ore story. Look at it from the other perspective. You know, when things improve, you've got a new Anglo-American emerging, and Mark Cutifani very committed to these kind of late stage precious metals and diamonds, as he calls them. I mean, Tandisizwe, how are you weighing up this argument here and the kind of value that a diamond portfolio will have to Anglo-America potentially further down the line if they are also able to convert more Asians to the diamond culture, if you could call it that?
Look, I think it's a good strategy to start off. If you look at the Asian market, and if you look at the income levels, they've actually gone up in the past year. Wages for urban areas increased by about 12.5%, rural areas by about 16.3%, and actually disposable income is also growing. And Mark Chirifani, from an Anglo-American perspective, have also shown that they're committed to the diamond story. They signed or committed, I think, about $2 billion to underground exploration of a mine in Limpopo, called Venetia. And I think David Mackay, spoke to one of the guys when he was in London, and they're expecting, I think, operating income. They're expecting diamond to contribute about 20% of operating income towards Anglo-American. And
that's if all goes well.
If all goes well. I mean, I think signs are that the Chinese market is definitely going to grow. The CEO of De Beers said that in the next 10 to 5 years, China will represent about a quarter of the diamond market. And a McKinsey report released recently, says that China will represent about 20% of overall luxury trade. So I think prospects are definitely positive for this strategy.
And there's quite a lot of talk about, obviously, the Chinese market, and it's a very simplistic example that you say there's X number of billion people in China. If you sell X number of noodles into it, you only need 1% and you'll be successful. And it's a very easy argument to just say numbers of China simply equate to profitability and payoff. Guys that are taking their brands into big markets like China and India, which do have big growth in both the middle and high income segments of the market, whose strategies are paying off at the moment, and what are they doing well that for example, De Beers can learn from in terms of targeting that high end of the market?
Well, they already have more than half of their retail outlet joint venture with LVMH. I think something like 55% of the stores are in Asia, so they're already going that way. The challenge when you just chase the numbers is that you may miss significant cultural differences between your home territory, if you like, and the areas you're moving into. And we see this in other brands. If you take a brand like BMW, in the emerging economies, in the BRICS countries, if you like, as a statement of arrival, as a measure of achievement, the BMW brand, like many luxury brands, is considered to be much more overt and much more aggressive, whereas in Europe it's evolved to a point of almost understated achievement. And to carry the same message into cultural areas that have different levels of evolution, different priorities, can sometimes see a brand come unstuck.
I think that one of the things that is interesting, you talk about BMW, for instance, I think that brands are having to re-evaluate themselves, both from, there's a younger population in a lot of these countries. Again, if you bring it all the way back to Africa, we've got a very young population, which speaks to more aggressive, younger, funkier marketing. Yep. Comparing that against high-end branding, so maybe let me rephrase the question. I think that if you're going from a high-end branding approach, what is working for people, not just the joint venture with LVMH, for instance, but actually getting on the ground in terms of active marketing strategies? What's working for people?
Well, I think that we are more similar than we are more different. So I think you can follow accepted routes to market by and large. It's crazy to reinvent the wheel every time. What you have got to be completely conscious of is the subtle differences on the periphery of the main marketing drive. As with the BMW example, as with many other categories where the attitude of consumers to that category may not be directly comparable with US or Europe or wherever, and you need to do your qualitative investigations to ensure that you understand that relationship, because insights are not things you can measure. I'm terrified by this concept of big data, which seems to me to take all of the intuition and all of the subtlety out of marketing, because you're just looking for the numbers to prove a case. If you can get beyond that and really invest in the difficult stuff, which is getting to know people, not getting to know statistics, then I think you'll find the way through.
And I guess, Sasha, I think the question then is, how do you cash in on this? I mean, I think people are all intrigued by this idea of exposure to, I mean, we've talked about BRICS obviously being the next generation of growth. There's South African companies that are doing it well. I mean, if you look at the way you structure your portfolios, both your local and your international portfolios, you know, which are the themes that really excite you getting into these markets?
Yeah, this one falls squarely into one of our 4 pillars of aspirational consumerism. But I think it also ties in nicely with a Chinese custom of gifting. So, you know, in the Mao years, that would have been non-existent because they went back to a subsistence-related economic great step leap backwards. And with the freedoms allowed in the local market, I think what you've seen is what was considered by the new Chinese officials perverse consumption. So many of those big billboards in some of the big urban areas were toned down. And in fact, Xi Jinping, the new guy at the helm of the Chinese Communist Party and of course leader, has had a big crackdown on party kind of gifting, because you know there's a corruption perception that has permeated, and people, for the Communist Party to have like an enduring success, they need to be able to tone down a little bit on this newfound wealth. So there's a
Are
big
you concerned
balance.
about that in terms of the impact it's going to have on Richemont?
It has already. It has already. There's been a market impact, and you
So
know,
it's something you're watching now.
It is, and in essence you can do nothing about it. It's almost like a slowdown which you're going to accept. It depends, you know, obviously if you're invested in Nike and McDonald's, which we are, to a lesser extent than obviously to a Richemont or a Tiffany's. There's a big more market impact at the top end, because I don't want to be wandering around with a fancy watch, but I can wear my Barcelona football jersey on the weekend and nobody will give me a second look.
But I think that's an interesting point, though, is the talking about, say, Nike versus Richemont as an investment. That tends to be more middle class, targeting the middle class for, you know, from an investment perspective, as opposed to the high end.
Yeah, and typically jewelry purchases are, you know, in the case of my long-suffering wife, only once every now and again. Whereas obviously with Nike, I'll tell her, no, you can buy a new Nike shirt, and she'll say, I need these new running shoes, and reluctantly we'll go out and we'll get a new pair of running shoes, obviously Nike. But I think you're right, Mark. I think, you know, those sort of purchases are soft luxury. And whilst you and I might not view a trip to the local McDonald's as a soft luxury, in some parts of the world there is. And you see, even in an African sense, you know, Yum Brands, and I think that was also in this this edition, have been making great strides. And you know, a trip to the KFC downtown Nairobi might be greeted with long lines, long queues, because there's soft luxury, and then of course there's the much harder luxury.
So what's your assessment, Andy, in terms of the potential for Anglo-American and I suppose De Beers to capitalize on the investment from the production side of things when it comes to the market out there for luxury diamonds, for the Forevermark brand overall for diamonds? Do you think that there's a growing market, and that this is going to prove the right strategy for Anglo-American versus a BHP Billiton that's divested in its diamond assets?
Don't ask me business questions.
But what I'm saying from the market
business
perspective
objective is to get my own net assets up to zero. So that's where I sit on this planet. But in terms of marketing, I do genuinely believe that their opportunity is to pursue the growing markets rather than market growth in established markets. I think there's elements of saturation in most diamond-friendly markets. And so it's a very wise strategy to be saying, let's get more people wanting diamonds rather than let's sell more diamonds to people who've got them already.
And what I'm saying is, do you think that those more people that it's hoping will want diamonds, and that the market is big enough for them to really be able to benefit from the investments they're making here?
Yeah, look, there's an old marketing expression that says, rather make things people want than make people want things. It's much easier to do the former. So you do have to have an underlying culture of demand for symbols of devotion and success, which is what diamonds are about. And the challenge, therefore, is to make the diamond that best symbol of devotion and success rather than tanzanite or platinum, whatever it might be.
But I think Sam does touch on something that is quite interesting there. High-end brands, whether it's shoes, whether it's diamonds, whether it is company, KFC in terms of a franchise-type brand, do they maintain their integrity going forward, or is it such a disruptive environment that long-standing brands simply can disappear overnight? You know, we talk about Apple, for instance. Is the investment into brands these days, or is the market so disruptive that a brand can be destroyed overnight?
Don't talk about Apple when Sasha's here. It's a very sensitive topic.
Let's buy some more stock.
There is a debate going around at the moment about what they call clean slate brands, which is to say that because we rely on people's opinions and experiences of brands before we make our own choices, historically that's meant long established brands are needed before there is any kind of momentum in terms of reputation. But now, with digital platforms being what they are, you can get 1 billion opinions straight away overnight. So it doesn't require that length of heritage. Having said that, though, the top 100 brands, as measured financially by the likes of Interbrand or Millward Brown, their average age is usually 60, 70, 80 years. You know, so while clean slate brands is an interesting concept in theory, I think it'll be quite some time before brands in our current understanding of them become a weakness.